So there's this classic philosophical thought experiment, right? The ship of Theseus.
Oh, yeah, the one with the wooden ship.
Exactly. The basic premise is, if you have this wooden ship, and over the years you slowly replace every single rotting plank, every mast, and every sail with new wood and new canvas.
Right.
By the time you replace the very last original piece, is it still the same ship? I mean, the physical machinery is completely different, but the name painted on the hull is exactly the same.
It's a great analogy for what we are looking at today.
Yeah, because normally when we look at corporate identities on Wall Street, things are pretty static. A software company is a software company,
Yeah, or a shoe brand is just a shoe brand.
Right. But right now, we are putting on our Talk Tickers hats for a deep dive into a company that is actively, aggressively replacing the planks of its own ship while it is still sailing at full speed across the ocean.
And that is usually when things get really interesting for investors.
Exactly. You look at the ticker symbol today, CPAY, and it might be the same letters representing the same corporate entity you saw 5 years ago. But the underlying machinery is entirely different.
Completely different.
We're breaking down the Q1 2026 earnings call transcript for Corpay Inc. And historically, if you knew this company, you probably knew them as the fleet and vehicle payment people, like the gas card sitting in the sun visor of a local plumbing van.
Right, that was their bread and butter for decades.
But they are mutating. They are turning into a massive corporate B2B payments powerhouse. And as always on Talk Tickers, we promise to be data forward, translate all the Wall Street jargon into plain language, take an opinionated stance on the results, and, give you an actionable bottom line for your portfolio.
And we really need that approach today because the disorientation this kind of shift causes in the market, well, that is exactly where the actual investment opportunity hides.
Yeah, Wall Street hates confusion.
They really do. They struggle to value a company that is shedding its historical identity to build a completely new future. Analysts try to apply legacy valuation multiples to a business model that just doesn't exist anymore.
So what makes the Q1 2026 transcript for Corpay so critical to understand?
It's because we aren't just observing a company attempting a strategic pivot. We are observing a company executing that pivot with a level of precision that is just honestly distorting their own financial models in the best way possible.
Oh, wow. So they are really pulling it off.
Yeah, they are firing on fundamental business execution while simultaneously capturing macroeconomic tailwinds. It is a rare blowout quarter.
Well, let's look at the actual mechanics of why that is. Let's start with the headline numbers, the data. So in the first quarter, Corpay hit $1.26 billion in revenue.
Massive number.
It really is. That's a 25% year-over-year increase. Their cash earnings per share, or EPS, grew by 29%.
Which ended up beating expectations by a full 35 cents a share.
Yeah, and they beat total revenue guidance by $50 million.
Yeah.
But, a 25% top-line revenue jump for a company of this scale is incredibly noisy.
It is because we know Corpay has been actively acquiring other companies.
Right. I mean, if you buy a new bakery, obviously your total bread sales go up.
Exactly. So the actual metric you have to watch here is the organic revenue growth, and that came in at 11%.
Which is huge. That marks the fourth consecutive quarter they have hit that double-digit organic growth mark, right?
Yeah, and organic growth is the single most vital metric for a company undergoing aggressive mergers and acquisitions.
Because it filters out the noise.
Exactly. Top-line revenue growth simply measures the total cash coming in the door compared to last year. It includes the revenue from newly acquired companies and the impact of fluctuating currency exchange rates.
So organic growth just strips all of that away.
Right. It isolates the core engine. It basically asks, if we pretend you didn't buy a single new company this year, and we pretend foreign exchange rates stayed perfectly flat, how much did your existing underlying business actually grow?
And hitting 11% for 4 straight quarters is hard to do.
It proves the core product is compounding. The sales teams are organically expanding their market share, and client retention is holding steady. It proves this isn't just a single lucky quarter fueled by a buying spree.
It's actual sustainable momentum.
Yeah, it's structural execution operating at the absolute high end of management's midterm target range.
Okay, that structural execution argument makes sense, but I have to push back a little on the $50 million revenue guidance beat.
Okay, let's hear it.
So they still operate heavily in vehicle payments, right? Which means they are deeply exposed to energy markets. Fuel prices go up and down. Inflation drives up the nominal cost of goods.
Sure, currency shifts around constantly too.
Right. So when a company with that kind of macro exposure beats guidance by $50 million, my immediate assumption is that they just caught a lucky break. Like, oh, oil prices rose, so they made more money.
That is a very fair assumption to make.
If the beat is entirely driven by inflation or fuel spreads, that isn't a sustainable advantage. Now, did they actually hustle for it, or was it just lucky timing?
Well, the management team actually provided the exact breakdown of that $50 million beat on the call, and 2/3 of that outperformance was driven by pure fundamental business execution.
Wait, 2/3?
2/3. It was higher volume, better cross-selling, and new client acquisition. Only 1/3 of the beat was classified as macro-related, which includes those higher fuel prices and currency fluctuations.
Okay, that is super revealing.
It really is. When a massive guidance beat is 2/3 fundamental, it tells the market the earnings are exceptionally high quality. The macro environment provided a tailwind, sure, but the primary thrust came from their internal engine.
So if the internal engine is driving that fundamental beat, we need to look under the hood and break down exactly which cylinders are firing. Which brings us to the actual mechanics of their corporate rotation.
Right, the shift away from the legacy business.
Yeah, the legacy gas card business is basically taking a back seat to the corporate payments segment. And that segment grew 16% organically this quarter. Corporate payments now represent 40% of their total revenues.
That is a massive chunk of the pie now.
It is. And spend volumes, like the actual sheer dollar amount flowing through their payment pipes, surged 43% to $82 billion.
Which is just a staggering amount of throughput.
And within that, cross-border sales skyrocketed over 40% in Q1. But there's a massive caveat in the transcript that I noticed. Management noted that the 16% organic growth in corporate payments would have actually been 18% if we exclude a 200 basis point drag from something they call float revenue compression.
Ah, yes, float revenue compression. It's a Wall Street term that sounds incredibly boring, but is actually vital to understand.
Please translate that for us.
So float revenue compression is a mechanical reality of the payments business. It operates entirely in the background, but it has a massive impact on the bottom line. Think of a payment network like a casino.
Okay, I like casinos.
Right. So the active business, the software sales, the transaction fees, the foreign exchange spreads, those are the high roller card tables on the main floor. But the casino also makes money in the background off the hotel rooms and the buffet.
Right, the passive income.
Exactly.
Right.
In the payments world, that background revenue is the float. When a client instructs Corpay to pay a supplier in Europe, the client transfers the funds to Corpay on, let's say, a Monday.
Okay.
But Corpay might not settle that payment with the European supplier until Thursday. So for those 3 days, Corpay is holding millions, sometimes billions of dollars in transit.
And they aren't just letting that cash sit idle in a checking account, right?
Definitely not. They sweep those funds into short-term, interest-bearing instruments, overnight reverse repos, short-duration government paper, basically things that yield a guaranteed return with essentially zero risk.
So when central banks have interest rates cranked up high, the yield on that short-term paper is huge.
Oh, it's massive. Corpay generates huge passive income simply by holding client funds for 72 hours. It is pure margin falling straight to the bottom line.
But, and this is where the compression part comes in, when central banks pause rate hikes or signal rate cuts, that yield drops.
Precisely. The compression is simply the headwind of a lower interest rate environment eating into that passive background casino hotel revenue.
Okay, so the fact that their corporate payments segment grew 16% organically while absorbing a 200 basis point hit from lower interest yields, that is actually a massive signal of underlying strength.
It really is. The active revenue at the card tables is accelerating so violently that is completely masking the declining revenue from the hotel. If you strip out the macroeconomic penalty of the interest rate cycle, the core business actually grew at 18%.
Wow. It demonstrates that the demand for their actual product, the software, the cross-border routing, the accounts payable automation, it's just completely decoupled from the interest rate cycle.
Yeah, and a huge driver of that product demand right now is global currency volatility.
Really? You'd assume that a highly volatile foreign exchange market would make mid-market companies freeze their international spending, like just wait for things to calm down.
You would think so, right? But in reality, volatility is the strongest catalyst for Corpay's services.
Why is that?
Well, imagine you are a mid-sized manufacturing company in Ohio, and you rely on specialized parts from Germany. Your entire profit margin is at the mercy of the euro to dollar exchange rate.
Right, because if the euro suddenly spikes against the dollar, your supply chain costs just increased overnight.
Exactly. And there's nothing your procurement team can do about it. That unpredictable cost variance is absolutely terrifying for a corporate CFO.
And Corpay uses that fear as their primary entry point.
Yes, they do. They approach that Ohio manufacturer and offer to hedge their foreign exchange risk. They structure forward contracts. They allow the CFO to lock in a specific exchange rate for the next 6 months, regardless of what the broader currency markets do.
So the client gets cost certainty, and Corpay captures a spread on the transaction.
Exactly. The wilder the currency markets get, the more desperate corporate clients become for risk management solutions. And that directly explains the 40% spike in cross-border sales this quarter.
That makes total sense. And the scale of the clients they're onboarding to manage this risk is entirely different from their historical base, right? The transcript reveals they recently onboarded a single payables client that is half the size of their entire PayMeRank business.
Yeah, they are moving from localized small-scale accounts to massive enterprise whales.
And to secure those enterprise whales, they are taking on giant cross-border risk management trades at incredibly low yields. The transcript mentioned yields that are sub 10 basis points. That is like less than 0.1% margin on the trade.
I know, taking a sub 10 basis point yield sounds like a race to the bottom, but the absolute dollar mathematics completely justify the strategy.
Walk me through the math on that.
Sure. If you are facilitating a $50,000 transaction for a small business, you need a high percentage yield to cover the operational friction and actually make the trade worthwhile.
Right, the juice has to be worth the squeeze.
Exactly. But if you are facilitating a $2 billion currency hedge for a multinational enterprise, a 5 basis point yield still generates $1 million in pure gross profit.
Oh, wow.
And the marginal cost of executing a $2 billion trade on Corpay's digital rails is virtually identical to the cost of executing a $50,000 trade. The computing power is the exact same.
So by dropping their yield requirements to win massive enterprise volumes, they are just maximizing the absolute dollar throughput of their infrastructure.
Spot on. It proves their payment rails are now sophisticated enough and their balance sheet is large enough to act as the primary counterparty for institutional grade flow.
But that infrastructure didn't just appear overnight. A significant part of building out these capabilities involves their M&A strategy.
Very true. They've been busy.
Yeah, they recently acquired a company called Alpha, and the integration of that asset is heavily detailed in the Q1 print. Now, Wall Street is notoriously skeptical of payment acquisitions. Combining two different technological backends is usually a total nightmare.
Oh, it's awful. You have different code bases, different compliance ledgers, completely different API standards.
Right. So what is the risk here?
The primary risk in any fintech acquisition is vendor lock-in and legacy technical debt. If you buy a competitor and simply let them operate their old proprietary software, you aren't actually generating synergy.
You're just running two parallel businesses under one roof.
Exactly. The true margin expansion only occurs when you force the acquired client base onto your proprietary technology stack and shut down the acquired company's servers.
Well, according to the transcript, Corpay has already migrated 15% of Alpha's corporate volume onto their own global tech platform. And the next major wave is scheduled for Q2.
Migrating 15% of the book within this time frame is actually huge. It indicates the API mapping and database merging are functioning without triggering catastrophic client churn.
Because when you migrate a corporate client to a new payment interface, you risk breaking their internal accounting software integrations, right?
Yes, and if you break their accounting software, they will leave. If Corpay can successfully navigate this migration, they will eventually deprecate Alpha's legacy mainframe.
And the moment those duplicate IT costs are eliminated, the profit margins on the Alpha revenue stream expand dramatically.
Plus, the Alpha asset itself is growing organically at 17% while this integration is even happening.
That's impressive. They also mentioned they hold a minority investment in a company called Avid, which saw its EBITDA, its core operational profitability, grow by 50% year over year.
When you have recent acquisitions and minority investments compounding at 17% and 50% respectively, it really validates the capital allocation strategy at the executive level.
Yeah, they aren't buying stagnant legacy assets just to artificially inflate their top line.
No, they are identifying high-velocity assets that accelerate once they are plugged into the broader Corpay distribution network.
But the massive success of the corporate payments division forces us to look the other side of the ship. Like, what is happening to the legacy vehicle payments and lodging divisions? Are they just being ignored?
Not ignored, but the legacy divisions are undergoing a sort of strategic triage. Vehicle payments grew 10% organically in Q1.
Now, we know a portion of that was subsidized by higher fuel prices, right?
Yes, but the actual volume metrics show stabilization. U.S. fleet same-store sales registered a positive 1% growth.
Just 1%. That sounds negligible.
For context, that same metric was negative 2% in Q1 of the previous year. It seems negligible, but crossing the threshold from contraction to baseline growth alters the entire financial model.
That turnaround in the U.S. vehicle market is driven by a very candid admission from management on the call. They essentially admitted their historical customer acquisition strategy was fundamentally flawed.
Yeah, they really owned up to it.
For years, they poured marketing dollars into digital channels, trying to capture what they called the micro market. You know, the 10-person plumbing company, the local landscaper with 3 trucks, the independent delivery driver.
And the unit economics of the micro market are incredibly punishing.
Why is that?
Well, customer acquisition cost, or CAC, is high because you are marketing to a highly fragmented audience, and the lifetime value, or LTV, of those clients is severely capped.
Because small businesses are acutely vulnerable to localized economic downturns.
Exactly. In a high interest rate environment, a 10-person plumbing company faces liquidity crises. They miss payments, they default on their credit lines, and Corpay ends up absorbing higher credit failure rates.
Plus, the churn rate has to be massive. A small business owner will switch fuel card providers just to capture a temporary sign-up bonus or like a slightly better per gallon rebate.
It is a totally leaky bucket scenario. You spend heavily to acquire a client and they either go bankrupt and default on their balance, or they leave for competitors 6 months later.
So management recognized this structural flaw and executed a hard pivot. They have redirected their entire vehicle sales force away from the micro market and pointed them directly at the middle market.
And that mechanical shift from micro to middle market completely changes the LTV calculation. Instead of chasing 100 local plumbers, the sales team targets a $400 million regional logistics company.
Which is a huge difference.
Massive. That logistics company might have 50 fleet vehicles, but they also have a massive supply chain, hundreds of white-collar employees traveling for conferences, and a highly complex accounts payable department.
I see. So when you secure that $400 million logistics company, you aren't just handing them 50 gas cards.
No, you integrate deeply into their operational software. You provide the fuel cards for the drivers, sure, but you also implement spend management software for the traveling executives, and you deploy accounts payable automation to handle their supplier invoices.
You bundle all of these disparate financial needs into a single, unified interface.
Exactly. Once a mid-market company integrates your software to pay their suppliers, manage employee expenses, and route fleet costs, they are structurally locked in.
Yeah, the friction involved in ripping out an integrated accounts payable system and migrating to a new vendor is massive. No one wants to do that.
The retention rates skyrocket. And the credit failure risk drops to near zero because a $400 million logistics company has the balance sheet to weather economic downturns.
This pivot essentially takes the legacy high churn fleet business and folds it right into the sticky high margin corporate payments identity.
It's a brilliant move.
But wait, I do want to ask about a localized risk factor in the international vehicle business that showed up in the transcript. Management noted a specific issue with a Google keyword algorithm in Brazil that negatively impacted their vehicle toll division.
Yeah, the Brazil issue.
When a company relies heavily on digital acquisition, a minor change in search algorithms can suddenly choke off top-of-funnel leads. The traffic wasn't converting properly, and it shaved a full percentage point off their growth rate down there. Is their international business vulnerable?
The Brazil keyword issue highlights the inherent vulnerability of algorithmic dependency in localized markets, absolutely. When your lead generation relies on a third-party search monopoly, you are always one algorithm update away from a demand shock.
Right.
However, the broader context provided by management isolates this as a tactical, localized issue rather than a structural failure. Despite the digital friction, the Brazilian division is still forecasted for high teens growth for the remainder of the year.
Oh, so it's a blip.
Exactly. Concurrently, their European vehicle business is maintaining a steady 10% growth rate through more diversified structural sales channels, so the international footprint remains robust enough to absorb localized digital potholes.
Speaking of potholes, the CEO explicitly used that exact analogy when discussing the lodging division. He referred to it historically as a problem child.
It definitely was a problem child.
For context, the lodging division provides software and payment routing for companies managing massive decentralized workforces, like construction crews, traveling nurses, specialized contractors. A couple of years ago, this division suffered a catastrophic IT infrastructure meltdown. The system architecture failed, the platform was unstable, and they just hemorrhaged clients. The same-store sales in lodging plunged into deeply negative territory, hitting around negative 18%.
An IT meltdown in B2B payments is an existential event. When corporate clients cannot reconcile their lodging expenses or guarantee rooms for their traveling workforce, they leave immediately.
They can't mess around with that.
No, the trust deficit created by system instability takes years to repair.
But the Q1 numbers show a massive reversal here. Same-store sales for lodging have climbed back to positive 6%. The CEO stated that by fixing the underlying technology and winning back client trust, they have effectively filled a massive pothole in their operational model.
The mathematical swing from negative 18% to positive 6% creates massive operating leverage.
How so?
Well, when a deeply unprofitable, shrinking division suddenly stabilizes and begins contributing to baseline growth, the net effect on consolidated EPS is exponential. It removes a massive drag coefficient from the company's financial momentum.
Management has enough visibility into this recovery to forecast mid to high single-digit growth for lodging in the second half of 2026.
Which is incredibly encouraging.
So with the legacy vehicle business pivoting upmarket, the lodging business functionally repaired, and the corporate payments engine running at 16% organic growth, we have to look at how management is projecting this momentum forward.
Because Q1 execution is historical data, the market trades entirely on forward guidance.
Right. And Corpay's management delivered highly aggressive upward revisions across the board. Let me read the numbers. They raised their full year 2026 revenue guidance to $5.29 billion, implying 17% year-over-year growth. They raised their full year EPS guidance to $26.70, which is a 25% year-over-year expansion in earnings.
Incredible numbers.
And for the immediate Q2 period, they are guiding for $1.295 billion in revenue and an EPS of $6.55.
You know, raising full year guidance in the first quarter is a definitive signal of extreme internal visibility.
Usually companies wait.
Exactly. Standard corporate behavior is to maintain conservative guidance through Q1, preserving a buffer for macroeconomic shocks later in the year. Willingly raising the bar in April means their sales pipeline, contract renewals, and margin profiles are locked in with near absolute certainty.
They aren't just projecting numbers either. They outlined a distinct philosophical shift in their corporate architecture. They call it their midterm direction, summarized by the mantra: fewer, bigger businesses.
I love that phrase.
Me too. They intend to consolidate all operations into 3 global pillars: employee payments, which encompasses fleet fuel and executive spend management; B2B payments, focusing entirely on accounts payable automation; and cross-border payments.
And to achieve this consolidation, they are actively pruning profitable but non-core divisions.
Yeah, the decision to sell the Pay-by-Phone division is the perfect case study of this strategy. Pay-by-Phone is a parking application business. It generates reliable cash flow, but management looked at the unit economics and realized it is a TAM-constrained asset.
Right, total addressable market.
Exactly.
TAM dictates the absolute ceiling of a business model. The global market for municipal parking applications is finite. Even with flawless execution and 100% market dominance, the revenue ceiling is hard-capped.
So by selling Pay-by-Phone, Corpay actively removed $75 million from their revenue guidance for the remainder of the year. The CEO also stated they're actively preparing 2 to 3 more non-core assets for divestiture before Christmas.
Now, to the casual observer, selling off $75 million revenue streams seems counterproductive when you are simultaneously promising Wall Street you will hit a massive $5.29 billion top-line target.
Yeah. Are they shrinking the company to grow it? How does that work?
It is an aggressive exercise in capital opportunity cost. You sell the TAM-constrained asset with a low ceiling, extract the liquidity, and redeploy that capital into the 3 core pillars where the TAM is practically infinite.
I get it.
The cross-border B2B payment market alone is estimated at $160 trillion. By divesting parking apps, Corpay frees up capital to acquire a strong European B2B payments player, or to fund the technological development of new industry-specific accounts payable software.
They're systematically swapping out low-velocity engines for high-velocity engines.
Precisely.
And as they refine this core architecture, they're attracting massive institutional partners. The transcript highlights a rapidly expanding partnership with MasterCard. Corpay currently has a $5 million run rate with MasterCard, with 50 specific accounts actively moving through the integration pipeline. They're specifically interested in multi-currency bank accounts.
This MasterCard partnership reveals a crucial dynamic about Corpay's technological moat.
Tell me more.
The legacy banking institutions that MasterCard works with possess massive balance sheets, but their internal software for cross-border transactions is often archaic. Building a modern, multi-currency virtual account ledger from scratch requires years of development and billions in sunk costs.
So instead of building it themselves.
Exactly. These banks are using MasterCard as an intermediary to white-label Corpay's technology. The banks maintain the client relationship, but the actual transaction routing, currency hedging, and ledger management run on Corpay's proprietary rails behind the scenes.
It just fully validates Corpay's infrastructure as institutional grade.
Without a doubt.
So the divestiture of these TAM-constrained assets like pay by phone leads directly into the most aggressive mechanical action discussed on the earnings call, their capital allocation strategy.
The way management is deploying their cash fundamentally alters the risk profile of the stock.
Yeah, the numbers are wild. A company's capital return program is like the ultimate polygraph test for management's true belief in their own valuation, right?
Rhetoric on an earnings call is cheap. Open market liquidity deployment is undeniable.
Let's talk about it. The board of directors currently has $1.8 billion authorized for share repurchases, which includes a newly approved $1 billion tranche. In Q1 alone, they deployed $786 million to buy back 2.4 million shares of their own stock.
In a single quarter.
In Q1 alone, they funded a massive portion of this by taking the $450 million in cash proceeds from the pay-by-phone sale and immediately pumping it into the open market to retire their own equity.
The mechanics of a share buyback artificially engineer a higher earnings per share floor. By going into the open market and destroying 2.4 million shares, Corpay reduces the total outstanding denominator of the company.
So every remaining share in existence suddenly represents a mathematically larger percentage of the company's total future cash flows.
Exactly.
The analogy here is like a real estate developer evaluating their own portfolio. Imagine you own a massive sprawling estate. On the far edge of the property, there is a specialized storage shed.
Okay.
You realize the shed has no strategic value to your long-term vision, so you sell it to a neighbor for a massive pile of cash. You then look at the market price of your own main house, analyze the foundation and the cash flow it generates, and realize the broader market is drastically underpricing your core asset.
I love where this is going.
Right. You take the cash from the shed sale and you use it to aggressively buy out your minority partners, consolidating your ownership of the wildly undervalued main house.
That is exactly the arbitrage management is executing. The CEO explicitly stated that their midterm goal is to generate $15 billion in free cash flow, double their EPS to $50 a share, and in a highly unusual display of conviction, stated they could potentially buy back more than half the company at this current valuation.
Stating on a public earnings call that you are willing to buy back half of your total outstanding equity is an unprecedented level of aggression.
It really is.
And they have the balance sheet architecture to actually execute it. Their leverage ratio sits at a healthy 2.7x, which is highly conservative for a company generating this much free cash flow. They have $1.4 billion available in immediate liquidity on their revolving credit facility.
And the mechanics of how they're managing that debt are just as impressive as the equity buybacks. They recently engaged the credit markets to refinance their core facility.
What do they get?
They secured commitments from institutional lenders to upsize their available credit by over $1 billion. They extended the maturity date by 5 years. And critically, they successfully negotiated a 10 basis point reduction in their interest rate.
Wait, really? We have to contextualize that 10 basis point reduction against the broader macroeconomic environment. We are operating in a restrictive monetary regime right now. Borrowing capital is expensive.
Oh, very expensive.
If a highly profitable mid-market company attempts to refinance their corporate debt right now, the banks are almost certainly going to demand a higher yield to compensate for systemic risk.
Absolutely.
Yet Corpay walks into a syndicate of institutional lenders, asks for an additional $1 billion in exposure, demands 5 more years of duration, and dictates a lower interest rate. And the banks agreed.
They agreed. Institutional credit underwriters do not operate on sentiment. They operate on raw cash flow modeling and covenant stress tests. For a banking syndicate to lower the yield on a $1 billion facility in a high-rate environment, their internal models must show Corpay's balance sheet as virtually bulletproof.
That is incredible.
The debt market is inherently more cynical and analytically rigorous than the equity market. When the debt market prices Corpay's risk profile lower today than they did 3 years ago, it is the ultimate empirical validation of the corporate rotation strategy. The cash flow from the new B2B pillars is so reliable and so structurally embedded in their clients' daily operations that the banks view the lending risk as practically zero.
So if the credit markets are validating the underlying cash flow, and management is aggressively retiring the equity float, we need to synthesize this into an actionable thesis. Based on the 11% organic growth engine, the structural pivot away from microfleets, the stabilization of the legacy lodging division, and the incredibly aggressive share repurchases, what is the ultimate verdict on CPA?
The data dictates a definitively bullish stance. The structural mechanics of the business have been entirely re-engineered to produce highly scalable recurring revenue. You are looking at an entity that now derives 85% of its total revenue from massive corporate and middle market vehicle payments.
So the exposure to the highly volatile, high-churn micromarket has been systematically neutralized.
Correct.
The scale of the opportunity in front of them is difficult to overstate. We touched on the total addressable market earlier. The transcript estimates the global cross-border B2B payment TAM at $160 trillion.
It's almost an unfathomable number.
It is. And right now, Corpay processes roughly 1% of that volume. The vast majority of that remaining 99% is not controlled by hyper-advanced fintech startups. It is controlled by legacy regional banks running outdated, manual correspondent banking networks.
Which means the runway for market share capture is vast. Corpay doesn't need to invent a new financial paradigm to double their cross-border revenue. They simply need to replace the friction of legacy wire transfers with their automated, API-driven software.
A corporate treasury department migrating from manual Swift wires to Corpay's integrated dashboard experiences, an immediate reduction in administrative overhead, and a massive upgrade in foreign exchange visibility. It's a no-brainer.
Absolutely.
But, a bullish thesis requires a rigorous analysis of the downside risk. We have to be balanced here. What are the structural threats that could derail this momentum? If a retail investor is building a position in CPA, what is the bear case?
The primary macroeconomic risk is severe float compression.
Okay, expanding on the casino hotel analogy from earlier.
Right. If the global economy enters a sudden, deep recession, central banks will panic and slash interest rates back to near zero levels. The massive passive income Corpay generates from holding client funds in transit would evaporate entirely.
Ouch.
Yeah. While they demonstrated this quarter that the active software revenue can outpace a 200 basis point headwind, a 500 basis point drop to the zero lower bound would severely compress their operating margins.
The active business would have to accelerate to unsustainable levels just to tread water on the bottom line. So that is the macro risk. What about operational risk?
Execution failure during M&A integration. Corpay is running a highly complex operational playbook. They are identifying TAM unconstrained assets, acquiring them, mapping their databases, deprecating their legacy servers, and forcing the client book onto the Corpay proprietary rails.
It sounds like a lot of moving parts.
It requires flawless API architecture and intense client handholding. If a database migration fails, or if a newly acquired corporate client experiences routing errors during the transition, they will immediately churn to a competitor.
Right, because software synergy only exists on a spreadsheet until the actual code base is merged. A single botched integration of a major asset like Alpha could permanently impair their organic growth trajectory.
Exactly. Execution risk is very real here.
Well, that brings us to the final and potentially most disruptive mechanical detail hidden deep within this transcript. It was mentioned almost in passing, but the implications for the global financial system are staggering. The CEO discussed their early initiatives regarding blockchain integration.
It is a profound architectural shift that the broader market has largely ignored.
Yeah, Corpay has quietly signed agreements with JP Morgan and a digital asset infrastructure company called BVNK to add real-time blockchain rails to their global settlement network.
Just quietly building in the background.
Exactly. The CEO explicitly stated that his personal bet is that moving tokenized assets outside of traditional banking hours will become a massive structural advantage for their B2B clients.
To understand why this is revolutionary, you really have to understand the mechanical friction of the legacy Swift banking system.
Break that down for us.
When a corporate client wants to send $5 million from New York to a supplier in Singapore, the money doesn't actually travel in a straight line. It relies on a web of correspondent banks holding Nostro and Vostro accounts, essentially pre-funded accounts sitting in different jurisdictions.
Okay, so a lot of middlemen.
Yes. The transaction must hop from bank to bank, navigating different compliance checks and ledger updates.
And the most archaic part of the SWIFT network is that it adheres to standard banking hours. It shuts down on weekends and national holidays.
Which is crazy in a globalized economy.
Right. If a massive supply chain emergency occurs on a Friday night and a manufacturer needs to instantly clear a multi-million-dollar payment to release a shipment at a port in Asia, the traditional banking system literally tells them to wait until Monday morning.
Capital trapped in weekend transit is dead capital. It generates no yield for the client and completely halts operational velocity. By integrating with JP Morgan's blockchain infrastructure and BVNK, Corpay is building the capability to bypass the correspondent banking network entirely.
So they're engineering a system where fiat currency is tokenized into a stable digital representation.
Exactly. That tokenized asset can be transmitted across a cryptographic ledger instantly, settling on the other side of the world in seconds for fractions of a penny.
And the blockchain never closes. It operates 365 days a year.
That is exactly the advantage. A corporate treasurer in London can instantly settle a massive invoice with a supplier in Tokyo at 3:00 a.m. on a Sunday. The liquidity is available immediately.
This eliminates the T+2 settlement delays that have plagued cross-border commerce for decades.
It does. And notice, Corpay isn't pivoting into cryptocurrency speculation. They're utilizing distributed ledger technology purely as a back-end utility rail to move institutional volume faster and cheaper than the legacy banks ever could.
It's an infrastructure upgrade. If Corpay successfully integrates these tokenized settlement rails, they aren't just taking market share from regional banks, they are actively disrupting the foundational architecture of global corporate treasury management.
It really makes you rethink what the company could be worth in 5 years.
Completely. The underlying machinery of the company continues to evolve, replacing legacy constraints with highly advanced, unconstrained digital infrastructure. This is the precise mechanism of the ship of Theseus playing out right in the equity markets.
It's a fascinating transition to watch.
It really is. The best investors don't just read the top-line numbers. They dissect the architecture of the business to understand how the machine actually generates cash. Keep your focus on the underlying mechanics, and the actual value of the enterprise becomes impossible to ignore. That wraps up today's deep dive into the source material. Thanks for joining us on Talk Tickers, and we'll catch you on the next one.